Talk about variance, standard deviation, and uncertainty. So one of the students actually correctly identified this. This is from the movie Twins. Variance and standard deviation are basically two of, I don't know, one and the same. I don't know how to describe it. They go together. If you can calculate the variance, you can calculate the standard deviation. And their last name is Volatility. Also, that's a joke. And the idea is that the higher the variance is, the higher the standard deviation is, the higher the volatility of the stock. So when we talk about our internet example right here, we say to ourselves, well, the variance of the internet startup is much higher because we don't know like what's going to happen. It could be an awesome thing. We could make $1 bazillion, or we could make $0, and therefore there's a lot of variance and potential outcomes. Whereas the grocery store that we said had like a 1% margin has not a whole lot of variance. I mean, obviously, like a real life grocery store in today would probably do that because people are buying stuff at the grocery store right now. But in general, the grocery store is going to have a lot lower variance because people need the same stuff every day. And therefore, this situation would be a lot better, and this situation would be a lot worse if you did not like variance. So variance is usually larger. Usually what you do is take the square root of the variance to get the standard deviation. Well, you don't usually do that. You always do that. And the variance and standard deviation tell us the same thing, how far the observations lie from the mean. And so what we're seeing here is like, you know, if the class average on a test is a 70% and the standard deviation is 5%, well, that tells us that on average, people are about 5% from the 70. So it's either going to be 65 or 85. And that is the first standard deviation that's like 68% or something of observations should lie between there if it's a normal distribution. We'll get into that just a little bit more later in the lecture. And again, the bigger these numbers are, the bigger the variance, the bigger the standard deviation, the more we're uncertain about a stock or whatever else we're talking about in terms of variance or standard deviation. So in that test example that I gave you, if the average is a 70, but the standard deviation is instead of 5%, 10%, or 20%, then we know that the observations, that the test scores are more spread out. So a 20% standard deviation means that most of the observations lie between 50% and 70 plus 20 is 90%. And that indicates a much bigger spread. So a couple things to consider in this about these issues. First of all, high risk does not equal high return. I'm sorry, high risk does imply that you get a higher return. People require that if I'm going to invest in something risky, that I need more of a return from it. But don't confuse this with stupidity. A lot of people make stupid mistakes because they think that the risk is acceptable. It's not the same. A true investor says, hey, this has high risk. I require more of a return for it. And therefore, you know, the price should be lower. But a lot of people make really bad mistakes on that, just investing in general. The relationship is also not linear. So imagine that you're eating a piece of cake. The cake that you have today may taste amazing, but the bite that you have in 10 minutes may be less amazing because you're tired of eating cake and it's really, really rich. And so on return and risk, just because I take on 10 units of risk additionally doesn't mean that I'm going to get 10 units of return. In fact, the higher risk, the lower the return may be relative to the additional risk that I'm taking on. These things are somewhat, I don't know, they're somewhat unrelated to this, but let's talk about it in this context. The risk-free rate, does it really exist? So they have this idea in finance of the risk-free rate. And really what that allows us to do is say, what's our return on this asset above the risk-free rate? So if I knew that I could get, say, 5% from a T-bill, which we haven't done in years, but let's say I could get 5% from that, or I could get 20% from investing in a stock. I'm going to pick Walmart. You could never get that again because Walmart's huge, but let's say you could get 20% from Walmart. 15% would be the risk premium, which is this definition right here. And that basically tells us that we could get an extra 15% in addition to the 5% that's kind of risk-free in the market. Does the risk-free rate really exist? No, not really. Is a U.S. government bond going to be safe forever? No. At some point, we will change hands or default on our loans or something, but For our lifetime, for the lifetime that is finance in general, we don't have to worry about that. We consider the US 10-year T-bill usually as the risk-free rate, and we just go from there. And the last thing is the risk premium is the compensation for risk. So for instance, if the risk premium, so the 5%, let's say that we had a 5% risk-free rate, which would be the T-bill. And then let's say, for instance, that we expected to get 20% on Walmart stock. This would never happen, but the end would be 20% minus 5% equals the risk premium. If things suddenly got riskier in the economy, like they have this week, and the price of Walmart goes down, well, that means that Walmart stock might have a 35% expected return, and therefore the risk premium is going to be 30%. And again, this would never happen. These are not real numbers, but it's just an example to show you, like, risk goes up, price goes down, and we end up with an increase in the risk premium for that stock and probably for the market in general. So that's a quick explanation of the risk premium, and I think I'm going to stop.